Cool. So this is a little intimidating for me right now. I'm on a Zoom call with two former bosses. If HR shows up to this meeting, I'm getting like, this is a company-wide riff for sure.
I out of happier to, I was Rodney, well, I know you know who Allison Chains is.
Yes, I know who
I
Alex.
well, so I was taking my older kid to drop off for tryouts today, and Rooster came on, and I was
Nice.
like, I cranked it up, and they were nothing but unhappy with me. Uh,
Solid.
yeah,
That's
she did not.
that's
It's
just
like,
some
come
good
on,
old that's just some good old school anger music right there.
right? I mean, we're going to go kick some ass.
Yeah.
Fucking yeah.
Yeah, I got to see the Flaming Lips and Modest Mouse last Thursday. Those bands on your radar at all?
They play in your backyard.
I went up to Madison for it.
Hmm.
They're good Madison bands. It was fun. It's a good time. You know the Flame.
I would have been impressed. Yeah, yes, I'm for the Flaming Lips about as well. I was gonna be impressed if they had made it to Dwight. Like that would impress me. Like that would have like that's a that's an awfully specific move.
Yeah, I
Not
was going to
quite.
say that.
Yeah.
I'd be surprised if they were already on the Dwight tour.
The you
It'd
know
actually be more likely that Alice in Chains was going through Dwight at
Yeah.
this point in time.
that's right. That's right. That's right. What's your favorite 90s band, Dean? You got to have a couple of those under your belt.
I'm a diehard Pearl Jam guy.
There we go. That's what we like to hear. I got
Yeah.
you can't see it on camera. I got a couple Pearl Jam
So
posters here.
Alice in Chains brings you kind of the anger, and Pearl Jam mixes in a little bit of the depression. And when you put the two of them together, it's just a 90s childhood.
That's right.
I enjoy driving my kids nuts when elderly woman sitting behind the counter at a convenience store comes on. Like I think I could sing that without the music at this point. Like I'm pretty sure, and that's a fun one.
Yeah.
So I
Um,
think I've seen Pearl Jam 5 times in concert, and that's actually the song that I go to the bathroom during when they play it. I'm like,
really,
all right, I'm gonna go reload here. I like their deeper cuts.
You
you want
I
could
you
didn't
want
you could go during Yellow Ledbetter since nobody knows the lyrics and he changes them every time.
exactly. Man, I didn't know you were a Pearl Jam fan, Dean. I'm surprised
Yeah.
that never came up before. Yeah.
So I went to Alpine Valley, whatever. It would have been like 2002 or something. Uh, it was late October and it was like 28 degrees when the concert started.
Oh.
So Eddie Vedder changed the lyrics in the middle of like 8 different songs explaining how cold he was. And while he's drinking an entire bottle of red wine straight from the bottle, it's pretty classic.
Yeah, I bet they don't have a lot of October concerts at Alpine Valley, right?
I wouldn't I wouldn't recommend it. I don't know if
Yeah.
they do have a lot of them, but we stayed in Chicago at a buddy's night the night before and it sleeted and iced like an
Oh,
inch and a half on the sidewalks. And then the next day we went up to Alpine Valley and yeah, it was 28 degrees. It was beautiful.
well with climate change, shit could be 50 now. Like
yeah, that's
That
true.
that is true. There's a lot of things that have changed since then. We've just created so many more carbon emissions.
I was gonna say opportunities for concerts and in the
100%.
winter.
100%. I'm a big fan of the global warming thing. It's really made winter more tolerable.
Well, so that's a funny thing. Like the tragically community. So way more humans die from cold still than from heat. And there are areas of the United States that get safer as the climate changes. So New England being one of them. Like it literally like it gets safer to live here as
Like,
long as you're not on the coast, right? Like there's like a
Sure.
tsunami
yeah,
hurricane threat coming. But if you're 100 miles inland, like yeah, you can raise more crops and the weather doesn't get as cold.
is
Yeah.
it safer like crime goes down or
No,
just
no, no. Safer from an environmental
yeah,
perspective.
yeah.
So overall, it's largely because it doesn't get as cold. Like that's the big one.
Yeah.
Uh,
Chicago, it tends to have the opposite effect. It creates a longer crime season. And so
That's right.
it has a little bit of a different effect there. The weather wise is good, but it does keep crime open for another 45 days longer on the tail end of the year.
Yeah, that's right.
I remember there was one day when I must have been, it was either seventh or eighth grade. So we were living in Shanahan and it was minus 80 with the wind chill. Uh, and an idiot kid, I was like, I'm gonna go outside and walk to the grocery store just to see what this is like. And I'll tell you what, I couldn't tell the difference between -80 and -60 or -50.
No. Right.
Yeah.
So,
At some point, it's just cold.
yeah.
Yeah.
The good news is we make up for it by being 105 in the summer with terrible humidity. So we catch up quick.
On average, it's beautiful.
On average, yeah.
Yeah, it is.
There's just never any average
For
days.
those 6 days a year that are average,
Yeah.
it's
Yeah.
pretty good. It's pretty good living.
That's right.
It's been a awesome week here. Like it's been like sunny, 77, give or take, working outside a lot. It's great. So that's one week this summer.
Same here. We're like high of 80, right? Lows of like, I don't know, in the 60s probably at nights. But this weekend's gonna be awesome. I got 5 yards of mulch showing up to my house on Sunday. I'll be spreading it in 70-degree weather with the wife out of town.
Oh, it's a lot of mulch.
That is a lot of mulch.
Yeah.
That sounds like 18 bush lights worth of mulch.
There'll be some bush lights. Yeah, that's what happens when you don't tend to your stuff the way you should. You just let it go. So then all of a sudden there's room for 5 yards of mulch.
All at once.
Yeah, that's all right.
So Dean, we haven't met before. So, or I guess Ronnie, maybe you should introduce him.
Yeah, I was going to do that. So Dean Durden, so Dean and I crossed paths at a little company called Grainco FS back in 2012. I got there before you, right, Dean?
Yeah, I was there. I started in 14.
Started in 14, yeah.
So you had already had 2 years to create plenty of messes before.
So I got
the HR comment earlier.
Yeah, exactly. I got the opportunity to work for Dean there for a couple of years through a couple companies. We went through a merger together, and it took a couple of years off our lives, but we made it through. Dean, so for those that don't know, I call myself an originator. Like that's how I focus. I'm really farmer focused, farmer facing, blah blah blah. Dean, I'll let you introduce yourself in a second, but Dean is more on the merchandiser side of things, right? So really thinks about how to maximize storage, opportunities and, trade spreads and all that kind of stuff. That's not to say he's not an expert. You would do well if you're a farmer and Dean was showing up on your farm and giving you advice. But Dean, why don't you tell us a little bit about your background?
Sure. So, farm kid from not far from where Rodney resides now, in North Central Illinois. Spent most of my years from being in the ag business at ADM. I took a 2 year hiatus from the ADM land, and like Rodney said, him and I worked together at a couple different FS companies over the course of like 2.5 years. And then I actually went back to ADM because I'm a sucker for punishment. So I went back. Then I ended up leaving, and I actually work for a private equity firm out of Chicago, trading spreads and things of such like Rodney was mentioning, just basically using, you know, 20 years of being in the cash market type of stuff to kind of leverage from a trading perspective. And then also work on a team of guys that are also mostly former ADM folks and work kind of in the risk management side. We work at Orchard Point Commodities, focus mostly on commercial risk, but we'll kind of work on all sorts of risk management as far as commodities go. So very cash based. We're we run kind of the wing tee when everybody's moving on to the RPOs and the five wide offense. We're still pretty much, we know where we make our bread and butter. That's kind of where we live. And, in the world of AI and algos and trading platforms and things of such, we're just kind of good old fashioned convergence guys that follow the cash, trade the curve, have a bias just watching convergence and things in the delivery zones, and that's mostly where we spend most of our time kind of focused. So have worked with Rodney on things in the past, farmer marketing ideas and things when we were at the FS. So I'm well rounded in those things. I did work on the hedge desk at ADM in one of my last roles, so that was a little bit more flat price focused, a little bit more risk management focused in the ADM flat price risk side of things, but as of today, kind of spend a lot of my time just focused in the cash markets.
Yeah, so Orchard Point, they're a commercial broker is what I would say, right? So your grain elevators and co-ops, when they buy grain from the farmer, they're hedging through, companies like Orchard Point. And they're leaning on you, Dean, a lot for like spread advice and stuff like that, right? Where am I going to place these hedges, et cetera?
Yeah, mostly based off of those types of things, like you said, spread risk management, basis management. You know, we get into the weeds on logistics and different things, fighting through some of those things, and then we will work with funds and ethanol plants and end user type of folks too that are kind of on the other side of that commercial mentality. So we kind of have a little bit of insight on both sides of the world, but um, it's kind of funny. You don't have to look at the world completely different for two different players. It's all the same stuff. It just depends on which side you're trying to kind of play defense against.
Yeah, exactly. And when you think the price of corn's going up, you advise these elevators to go long futures, right? Long
Yeah,
flat price and just take a ton of exposure.
we're big proponents of taking huge flat price positions and just, you know, sometimes you just got to put it on black and see how it turns out.
Not true, not true, by the way. Any farmers listening, they're hedging everything mostly. Yeah, and then the other thing I'd say is so I recently started a brokerage business here, and I'm an associated person with Orchard Point. And really part of that decision was, you could go to any like brokerage company and, trade futures all day, no problem. The unique thing about Orchard Point for me was that cash-based mentality, right? Like really understanding, hey, this is how it affects your cash position. I've just seen too many people get wrapped up in brokerage and not tie it to the cash, and you just don't know which way's up. You think you're winning when you're losing, and the opposite's the truth as well.
Yeah, and the how the curve reacts to thing is going to dictate a lot of different decisions, whether you're farmer, whether you're end user, commercial, the impact that the spreads are going to have are going to impact you whether you realize it or not. So it's kind of a missing component in a lot of risk profiles.
Yeah. Yeah, so I think we gotten away with from saying this, Gabe, but I think this is a good time to say we're not here to give futures advice, trading advice to anybody. Me and Dean are both on the hook for making sure that we're not, giving advice
You
when
got a
we don't
Series
know.
3, don't you? I think you're allowed to give advice if you got a
I don't
Series
know.
3.
There's something, but I do think with Dean on, we're definitely going to be talking a little heavier in the markets, right, than maybe we have in the past. But Dean, spreads have been interesting this year, right? Some uniqueness going on. What are you seeing there?
Yeah, so it's one of those weird years where you transition out of tight S&Ds, which people will argue how tight based off of how things kind of finished out in the old crop, but tight S&Ds rolling into burdensome S&Ds. So you had this really quick switch flip where old crop tight in the US, South America comes on with a big crop, starts to water everything down. US plants a big crop, grows a big crop. Now we're in the anticipatory phase of, okay, big supply coming. How are we going to put it all away? How are we? And, through that whole cycle, we went from big old crop invers right down to the bottom of the carry to gigantic carries into the new crop. And, kind of one of those classic, we use the phrase a lot from an Orchard Point perspective that, futures are a discounting mechanism and so are spreads. They're a futures market, not a present market. So they're trying to price what is going to be happening over the course of the next 60 days, 90 days, 120 days type of thing. So, we've broke things to be real cheap, real early. I mean, we're not even at harvest yet, but we're already at levels and spreads that are wider than what we see it in the bottom of the new crop carry at a lot of different years, based on different S&Ds and stuff. So it's flipped full circle. And now you're kind of caught in this purgatory moment where, USDA comes out with gigantic yield prints, everybody bears supply, but everything's already in the tank. So it's one of those, okay, well, it's bearish, but are we overshooting the runway one way or the other? There's a million different dynamics based on China and RVOs and biofuel policy and all of these different things that can flip a switch at any given moment that can create a lot of volatility. So it, kind of today was a prime example. you're in the middle of every conversation is bearish with everybody that you have, and beans are up 18 cents and they're 80 cents off the low from the report. So it's
What a
like
mess.
we're still
Yeah.
talking bearish, and in the meantime, beans have rallied 80 cents in our face, and everybody's still basically making a bearish argument. So it's one of those classic cases of, yeah, it was bearish, but the market's kind of signaling something a little different in the short term.
Well, and that's where you go back to it's the futures market, right? This bearishness has already been figured out. I mean, when we saw the report come out at 188.8 and the market does not react at all, right? In fact, I think we closed higher that day or
Well, we closed lower that day, but then we never broke that low from report day. And
yeah, that's right.
now
That's right.
now you're 20 cents off of what that report day low was, and you never broke that report day low. So more or less, it's the market's way of kind of saying, cool.
That's
Uh,
it. Right.
yeah. Um, Big number. Well, we kind of got told we'd see a big number. So now what do you want?
Yeah, I think the funniest thing about that too was I don't think anybody would have been surprised if they would have came out with like a 184, 185, but I think we would have gotten the same reaction out of the market, right? It's like,
It felt like going into it that it was kind of one of those, the market wants to buy a bearish report, whether it's for a short-term pop or whether it is, the low. Um, Kind of the crazy thing is this wouldn't be the first year that you've put in a seasonal low on the August report.
right.
The last couple of years, we've tended to put our biggest print up in August and then kind of dial back a little bit as we go forward. So, you know, theoretically, if you want to read the tea leaves of what the market's kind of saying, that would seem to be what the expectations are is A, those are the biggest numbers that we're going to see, or B, bean demand's maybe not as bearish as what the whole world is trying to preach as far as, zero China. So
Yeah.
it's it's kind of it's a market functioning at its best. It priced in the bearishness ahead of the bearishness, and then after it got the news, it more or less said, "Now what?" We've kind of traded that.
Yeah. Right. Yeah, and then today, I mean, no real new news here, right? I think today was Twitter driving the market, right? This last slug of the Pro Farmer Tour, and finally seeing some, I saw one of the pictures of Tassel Wrap or whatever finally showed up in real life, and um, I think that's what got the market excited, right? We didn't get a fresh number out of them or anything yet.
No, no fresh number. There was some news out. The Trump administration is supposed to announce basically some resolution to SREs that date back all the way to 2016 and how we're going to come to a resolution of that. So bean oil was up almost limit at one
Mm,
point in time. So I mean, that's kind of it's not a new nuance, but it's something that is going to have as big of an impact probably from a bean price as more so than what we've historically seen is we're transitioning from a world where we used to crush for meal and now we're going to crush for oil. So you
yeah,
used to really watch crush margins and it was really a meal driven margin because oil used to be the byproduct. And now oil is kind of turning into the driver and meal is turning into somewhat of, I hate to call it a byproduct, it has a huge demand base, but it is turning into more of the passive product than what the oil used to be. So, you beans, a whole bean is meal and oil. So when the products are finding a bid, you tend to find some bid in the bean market itself. So oil having a big day and potentially some biofuel news here over the next couple of days kind of seems like it put a little bit more support under the bean market.
yeah, nice. God knows we could use it. Bean market scares me to death, man. The corn market, I'm telling guys, it sucks. We're losing money. We've known we were losing money. We might out yield ourselves, out of our problem. But at least we have this crop insurance covering us on the downside. We're $1.50 away from crop insurance on soybeans and still at, just as unprofitable records here or, returns.
Yeah, the bean side kind of still is a bit ugly. We're getting back up to some values where hopefully you can start looking at maybe some break even type of levels depending on what your operation looks like. But um, yeah, it's just kind of strange that we kind of had the world set at a 11.50 to $13 market, and that was where you were trying to live your margins. And now we've reset that a dollar lower, and economics haven't moved back into what that price response kind of is. So yeah, it's pretty tough. It's
Yeah.
tough.
Yeah. You talked about China being at zero. That's true. So normally we'd have a few export sales onto China, although I think last year we didn't have very many at this time anyway, right? But it wasn't zero.
It wasn't zero, but they did have a late start last
Yeah.
year. And last year was one of the first years that we saw them actually stay more hand to mouth, which really caught the market off guard. They were so used to China putting on a 3 month book in front of themselves that you kind of already had a book to walk into before you started getting hit with cash beans.
Hmm.
Last year was kind of the first year that they kind of waited for it to turn into a disaster on the front end without overbuying it. And then when it finally got cheap and harvest got to 50% and it felt like, okay, that's max pain point as far as logistics and things of such, then they started getting aggressive. And so they really picked up their pace when we got into more like November forward type of positions. And, you know, this year you obviously have some different dynamics that are driving the fact that there's zero China, but it was an easier argument when beans were, you know, $10 or sub $10 to basically say small China, no China demand, et cetera, is kind of baked into the pie. Like we're pricing it that way. So
Right.
it seemed like there wasn't a huge amount of downside risk as far as that goes. Now that you rally a dollar and you put a price that's closer to $11, you start to wonder what exactly you have priced in and what exactly you have coming for you yet.
Yeah.
And then, so the squeeze in China in terms of timing, right? Is that so? Given, did it feel like that was a philosophical change on their part last year, or was it, with just wondering about things with their macro economy, right? Overall, slowing down quite a bit. Like it feels like anybody else, you'd slow down when you were spending and be more frugal about when you're pulling the trigger. I mean, so does it feel like a fundamental shift there, or was that just like a weird behavior? And then this year is a weird behavior because of the
It feels like it was a
administration.
little bit more of just a change in style or behavior on how they have traditionally merchandised last year. Part of it is that South America continues to grow bigger and bigger crops, and they've got a longer tail to their export program, and therefore you've got a longer tail to execute and kind of continue to let the U.S. restock harvest wise, build carries, get cheaper, and then kind of hit the door. So Southern Hemisphere crops are going to drive a lot of that. And in a year where South America is going to come up short, it's hard for China not to be kicking doors on the U.S. gate sometime late August, September, right through October and forward. Um, you get a year like, well, this year is a good example. I mean, they're continuing to execute South American beans today, and they've got September more or less booked out of South America. 50% plus of October is booked out of South America. So you've stretched their window right into the front end of our window. And so that's where we have lost obviously some demand. We used to have 2.25 billion export programs to China. Now this year people are talking on the low end of having a 1.2 billion bushel bean program. So almost 50% of what we've historically done, which still seems to be kind of on an extreme case, assuming zero China type of deal. Um, but it certainly is having its impact. I mean, they're able to find coverage much deeper into our harvest than what they've historically been able to find.
And it really is a pricing mechanism, right, Dean? I mean, they're buying them cheaper out of South America. It's not necessarily because we're, in the middle of a tariff negotiation.
They it is somewhat price driven. The tariff, spat that we've had over the last 60 to 90 days has certainly had its impact. But we were cheap enough at one point, a couple weeks ago where US beans were getting close to being competitive with them for like the November, December timeframe, but we still didn't see them engage in anything from an American standpoint. So it does feel like there's still politics at play. Um, Values are not that far apart. And if you remove tariffs, then we get competitive really quickly. But as of now, obviously, when you're at the negotiating table, it certainly feels like it's a Chinese strategy to stay out of the market until they see something that looks a little bit more beneficial in a trade deal.
Yeah.
Well, also, I think in South America they've gotten a lot better at moving stuff out of the interior, right? Their logistics have gotten stronger, and but they also haven't built out the storage for it. So it's like it is harvest it and move it, and so I think that probably drives some pricing that maybe isn't super transparent outside of the actual deals happening that make that more attractive. And like you said, the tariff stuff doesn't make anything better. Um, and depending on the administration, there was always the classic China started refusing beans, right? Like when that happens out of whatever magical problem
Right.
they discover and what's getting shipped over. And so I think before we would have just taken our licks on it. That's probably not the case now, right? You would expect other retaliatory behavior, and so it's probably that's another reason that they're probably not buying forward some of that stuff because they don't feel like they have the ease of rejection of ships that they used to.
Yeah,
And
and frankly, if there were a time to try to flex some leverage, they've got their opportunity. I mean, obviously, if it was a short crop in South America, they would have a lot less staying power to be able to stay off the world market. But it just so happens that when we started to start a fight with them this time around, they actually had some weapons to fight back, and they've used them so far. And it the one thing that the U.S. has maintained, and as far as I am aware, the policy hasn't changed. But when they do rebuild reserves, they don't put South American beans into reserve. Questions about storability, all these different things, but basically historically they've never reserved South American beans. So it's kind of interesting because of all the years where you would look at a restocking potential. I mean, before we had this recent run up in beans, you were talking about $10 futures and 60 under cash basis and 60-cent carries to the back end of the curve and all these different things that basically are screaming to a merchandising mind that if I've got open space, I should be filling space.
Yeah.
And we still didn't run into any reserve buying. We still didn't run into any, off the cuff buying as far as US beans go. So it that alone kind of sends the indication that it's it's it seems to be more politically driven than it does necessarily economics at the moment.
Hmm. Yeah, interesting. Uh, so Trump's first time through, a similar thing happened, right? Didn't we? That was Trump, right? When we kind of stopped exports to China before, and I remember that happening, and it felt like, oh man, this export business is gone. We're all gonna fold. And it turned out like Canada started buying containers, which I assume they were shipping straight to China. Probably more of a basis issue, right, than an overall futures and demand issue. Is that right, Dean?
Yeah, I mean, in a lot of ways, it's one and the same, right? If if you're a true cash convergence type of person, then obviously when you're looking at a bean price that's 1050 and a basis value that's 60 under, there's a lot of argument to say futures are overvalued. Maybe basis is cheap, but futures are probably a little bit overvalued type of deal. So you at some point you do have to find that convergence value. Basis does need to converge at some point when you get into a delivery period with a contract month. So, as you continue to see some of these big discounts to the board in the cash markets, as the board runs, it makes you feel like the board is kind of starting to get a little bit more disconnected with fundamentals the more that we run from where we're at right now. Um, you know, it, the thing about basis spreads, cash, all of those things that go into the conversion side of things is it's it's all about velocity or lack of velocity. And so harvest is the one time of year that it's hard to shut velocity off. The crop has to move, the crop has to find a home, and guys aren't going to let it stand in the field. So if there's no outlet value, the value has to back up to an extent where either you force that supply to find demand or you keep finding more space to tuck it away and it keeps adding more and more carry in order for you to keep getting more creative in the way that you can store that commodity. So that that is the one time of year where if things can get ugly, things can get ugly. I started in the grain business in 2005, which was the fall of Katrina. And I mean, I was in the St. Louis area, and cash corn, we went home a buck 62 one night and beans were 4.92. And a lot of that was just cash basis. There was no outlet at the Gulf. And so the market was literally paying you dollar to dollar 50 type of carries if you could figure out a way to keep it rat holed away. And
Yeah.
so that is part of the function of the market. When you lose that outlet, you have to get to a price that somebody will take it, or you have to get to a price that you can afford to fill your garage up and park the Buick outside for the rest of the year. So like it has to do that. And then once you get that tucked away, then you can start to make the argument of, okay, well now we have big carries, now we have the velocity shut down. Now we're going to find out what that incremental bushel is on the front end in order to pry it out versus that carry. But it's just tough to make that prediction today because, as we all know, once harvest starts, it's just Wild West. I mean, things start happening, and whatever plan you had probably gets ripped up 3 different times, and you try to figure out what you need to do on the go. But until you can get the velocity shut down and then kind of just take a look at the world with a clear view, get things stopped, get the crop tucked away, then we can start arguing about, okay, what's cheap? Where's demand? What's the carry look like? Is there too much carry? Is there not enough carry? All those different types of things. But until the bullets stop flying with harvest, it's just hard to kind of determine where that all balances out.
You talk about the conversions. It's funny. I can remember. So when I was at Cargill for a long time, Dean, and I sat on the U.S. kind of trading floor, right, where the cash guys were.
Yep.
And occasionally, and I say occasionally, I can remember two distinct times at least where we were not my desk. I sat on a derivative desk, but like the cash guys were holding a position intentionally into delivery because the spread was getting so goofy, and the exchange was calling. The reason I know the exchange was calling up is they were calling into our desk first, and they were pissy about somebody holding on to a contract, right? And we're like, the cash guys was like, "What the hell? Like, I'm following the rules. What? I'm allowed to take this to delivery. What's your problem?"
Yep.
Yeah, that was always interesting, seeing that, be able to see that pressure come through because there wasn't actually, like, there are position limits, right? So you're really reduced in the exposure you can have.
Yep.
But yeah, obviously at Cargill, they're fully equipped to handle the logistics of making and taking delivery.
Right. If they're there, they're well aware why they're there.
Yeah. And so the exchange enjoyed letting us know that they were not happy, because there's probably some massive fund who forgot that it went into notice period, and like there's nobody getting out of anything, so now they're stuck. And yeah, which Cargill, I'm sure, was also happy to help them out with for a price.
Hey, there's a price to get out.
Right.
There's a price to get out, and that price is wherever they can find cash. So if the fund manager needs to be the liquidity to get out on the other side of that cash transaction, then that's what it is.
Yeah. I got delivered on a bean contract that I held too long one time. Yeah, it turns out if you pay, you can get out for sure.
Yeah. All it costs is money.
Yeah, that's right.
Sometimes a little bit of pride.
Yeah. So, Dean, you have a small farm operation that you're involved in, right?
Yep.
What you want to tell us a little bit about what you got going on there?
Yeah, so I farm with a group of partners. My dad retired, and it was actually guys that I grew up with in the neighborhood that they had their own farming operation. So as my dad retired, I kind of took on his branch and merged it up with these guys. We've got a farming operation called Wolf Creek Ag. We farm about 2,500 acres, Streeter, Ottawa, Marseilles area. Strip till, no till, so mostly conservation type of tillage practices. Corn, soybeans, we don't get too far outside the box in our part of the world, but we have obviously tried to maneuver with some of the new techniques and with some of the 45Z stuff that's coming down the pike here that we're all kind of trying to learn more about, but kind of see the opportunity in it. We're trying to put ourselves in position to be able to capitalize on that whenever the clarity of that kind of becomes more on the forefront. So I'm polo guy and office guy as far as the farm goes. I do my obligatory 4 or 5 days in a tractor in the fall, mostly just as a getaway, not necessarily looking for any work. And if something breaks, I have to call one of them because I'm not interested in fixing it either. So I'm kind of more on the background as far as marketing and things of such. And when it comes to walking through cornfields this time of year, I just take their word for it.
Yeah, that's right. Like 45Z, is that what's driving the tillage practices that you're doing, or?
So it kind of started out. It kind of started out that we were interested in going towards the strip till model, anyways. Fertilizer efficiencies, equipment efficiencies, um, kind of looking at it through those lens more so than necessarily the 45Z when it got started. Um, but then as things have evolved and things have kind of started to grow into some government policy stuff, we have become more involved. We worked with a cover crop program through the Soil and Water Conservation. Um, have obviously stayed on top of some of what the tax, benefit stuff is on conservation, and um, obviously are paying close attention on some of the 45Z stuff. So I wouldn't say that that's where the motivation started. It started out more so looking at it from an ag economic perspective and just looking at something that saves trips across the field, maybe gives us an opportunity to find some fertilizer efficiencies. Um, don't have to have a 600 horsepower tractor to go chisel plow ground. We can get by with mid-size equipment type of stuff. But obviously, as time has evolved, it's looking like there's potentially more benefits to it than that.
Yeah. Yeah, cool. Well, I know you're not here to give agronomy advice to anybody, but what kinds of stuff do you bring to the table on the like more merchandising stuff on the farm? Is it like crazy different than merchandising for some gigantic ADM facility, or what's the story?
I wouldn't say it's gigantically different. I mean, at the end of the day, like it's kind of all the same stuff. It's cash, it's basis, it's space, it's carries, it's what pays more carry, what's is it worth taking this to the bin, or is cash flat enough that we should just sell that to the elevator type of thing. So it's it's very much the same thought process. It's just it drives, I would say I probably drive my partners crazy more than the way that I feel that it's crazy. Like managing grain assets prior, you just kind of get used to the fact that something changes every day. So what we talked about yesterday isn't necessarily applicable today anymore.
Yeah.
Or what we talked about before harvest is completely off the charts. We're not doing that anymore. We're going to do this type of thing. So I think that is more of I'm comfortable with that because that's basically how we've had to manage businesses in the past. It drives them a little bit crazy because obviously they want to go to a game plan and they want to stick to that game plan. And when I call them halfway through and say, hey, by the way, we're absolutely not doing any of that. Here's what we're going to do. So it they're usually cordial, but their silence is deafening at times when they're on the other end of the phone.
Well, and it's a different ball game, right? Like at EDM, you might have been doing shifting around a million bushels here and there, but I'm sure you're calling these guys up saying like, "Hey, we need to haul 15,000 bushel, in
100%.
some place we weren't going to do that before."
100%. Yeah. Somebody just called and we've got, 15 cents better to go there today. Let's go there today and we'll go back there tomorrow kind of thing. And they'll be like, that doesn't make any sense at all, but sure,
Yeah.
we'll go for it.
That's
Or
awesome.
Whatever, weirdo. Yeah. All right.
yeah, whatever guy that doesn't work and just calls randomly from an office somewhere. So
You have a nickname on the farm? They don't call you Polo.
I would assume I have one. I'm not aware of what it is, but I would assume I'd be curious if I called like one of their cells while I was standing next to them, what my name pops up as when I. But it's very much kind of the same game. I try to be really aggressively marketed going into harvest. My mindset always is I can protect a sale. I can't do anything once things hit the shitter. So my style is I'm not going to say regardless of price, but I'm big on getting sales out like right now. I'm looking at accumulators and looking at things in 2026, trying to get a baseline of something that is at a price that I can live with. So 475 and $11 bean type of accumulators get a 10 to 15% sale as a baseline out there. I'll build off of that. And then I'm kind of a fan of playing the seasonals and saying from January to May, I need another layer. And then I hope by July I get one more rally. Hopefully we feel pretty confident about what our crop prospects are at that point in time. I'm gonna I'm gonna hit that summer rally and then I'm gonna lock floors on whatever incremental stuff isn't out there. And then I usually try to get it hedged. And then as we get closer and closer to fall, you just start figuring out what your logistics look like merchandising wise. So this is going to the bin. This is going here. We've got a premium we can sell early here. And you just kind of start trying to lay them out. And then if at some point in time you want to re-own corner beans, that's a button click away instead of piling it into a bin and hoping to God that you catch a rally later on type of deal. And I'm not going to say that I always am right on top of it in that fashion, but that is ultimately what the goal is as you get there is at least be marketed, then market it according to cash values. So get your futures tied up, then market according to cash values, then decide how you want to reown that if you want to reown it at all. I would tell you historically, I'm not a big reown it guy. By the time I figure out that I am interested in maybe reowning old crop, I just look down the curve at new crop and say, I'm still long. Uh, I don't need to buy more.
Buddy, long forever.
I've got more coming. So
Yeah.
obviously from certain levels, this year, a prime example, you never really had a price to create a big windfall. So if things do crater out here and we retest lows or we get back to the lower end of things, I'm not opposed to looking at reowning some things, but there again, I'm not gonna go real aggressive trying to remarket things the second time. I try to turn the page and move on to next year.
I mean, when I hear you talk about mindset, right? Like, and so as a trader, right? We very intentionally focused on managing our portfolio risk.
Yep.
We didn't go looking for spec trades. I think technically under the charter that we operated, we could have gone and traded volatility, right? We would at Cargill, I think we were allowed to do that, but we didn't, right? Because and my boss had a really strong thesis that like if I'm spending time looking for a trade, I'm not spending time defending the portfolio, right?
Yep.
Optimizing portfolio.
Yep.
And when I hear the way I hear you talking, like reowning really feels like you're going and looking for a trade, not managing your portfolio.
Yeah.
Does that line up with kind of where your head's at, or is there some other set of principles driving that?
It does. And so when you try to combine looking at it from a merchandising perspective and a risk management perspective, the hardest thing for me is once I market my bushels that have to move at fall, I'm starting to look at how the carry is telling me to manage. So as long as I'm hedged, if you're going to pay me to keep carrying, I'll keep rolling out and I'll keep trying to capture the carry that way. If you're hedged and you can look at it in a carry market that way, it gets harder to justify wanting to reown the crop because if I can pick up 15 to 20 cents by rolling to a summer month, now if I go buy an option that costs me 15 cents, I need to overcome the carry and then I need to overcome the price of volatility. And then I start to make money covering up the cost of the crop. So part of that is trying to get it hedged correctly the first time, right? So you're trying to, you're doing your best to get yourself to a profitable spot to start with. And then you're trying to merchandise your way into added value later. And that I would tell you in a carry market, that one is what usually really brings me pause to try to go out and defend a sale is, I look up today and it's like Nove beans are 10.50, Jan beans are 10.80, March beans are almost $11. So theoretically, if I'm unpriced, but I have space, I can go sell my $11 beans today and I can go get them out of the March. Otherwise, you're asking me, do I want to buy time? Do I want to buy carry? Any of those things. But now you're asking me to probably go out and buy calls in the deferred that are $11, $20 to $12 calls. So now the board's rallied 80 cents and I'm playing for it to rally another buck to start trying to capitalize on that. And maybe that doesn't bother you when you sell $13 beans. You're willing to dump 30 cents back into it to stay in the market. When I'm selling 1060, 1070 beans and then turning around and going to spend 30 cents to see if I can capture another 80 cents from a rally perspective, it gets harder and harder for me to look at it and say, that's what's best for us this year. Because in a year where we're obviously trying to manage a budget, I I don't have it necessarily in the budget to just go spend another 30 cents and say, well, we'll see if it rallies. Worst case scenario, in a year where you got to sell 13 or $14 beans, you're sitting there going, well, whatever. I'll spend 30 cents, and if it goes to 16, great. If not, I sold 12.80 beans.
Yeah, well, and
Not
at that point, you're protecting against, cost of cash rent increases, right? Or like, there's definitely some reason to protect that upside when things are good.
Correct.
But yeah, super hard here.
But it is. And like I said, if when you start talking about beans that are sub $10 and corn that's sub $4, all of a sudden you start to have a little bit more appetite to say like, well, what is my real downside risk here? I'm just going to sell them here, turn it into cash, and then protect it. I don't have an argument for that. When you get down to values where it's just kind of one of those deals where it's like, I mean, how much worse can it literally get? Is corn going to go to 350 and beans 950? Okay, well, I can see that floor from here. When we get beans back to $11, if I still have beans to sell, it's kind of one of those deals where it's like, I'm just going to sell beans and I'm probably not going to worry about it. I'm I'm just going to cash flow my way through this thing and we'll see how the cards fall later on.
So you said a little bit earlier that you're looking at 26 crop now. Do you for your own operation that you're involved in, are you looking at going heavier given the size of the crop this year? And like, because you can do what for, well, you said you hit futures levels probably at 475 with an accumulator and some other types of structures. Like, is that, so are you leaning heavier there, or are you still applying kind of the same approach as you would any other year?
So I'm just trying to get a baseline 10 or 15% on the books for stuff back there.
And that's normal for you, is 10 to 15%?
It's normal for me under the circumstances. Under the circumstances, those levels are probably somewhere in the ballpark of break even if you assume average yield type of stuff.
Mhm.
So theoretically, it's not that prudent of a sale. It's not a boy, I just got to go get tied into this because I can't afford to miss it.
It's not $6, yeah.
It's not $6. It's not a no-brainer. If it was $6, I would be making an argument that I should be 50% now and looking for every opportunity I could to get to 70% when I get an opportunity to do it. But when you're looking at levels that are sitting there hovering at break even, at those levels, you could yield your way to prosperity, but I have no guarantee that I can do that next year. So it's more along the lines of I just tend to get a baseline on at a value that I can sort of live with. If you gave me the opportunity to sell 475 D's futures today for this year, I'd be pretty happy.
Oh
so now I've got the opportunity. I've got the opportunity for next year to actually execute on some of that if I can accumulate to it. So if I'm talking today about, man, if only corn was 475 and I have corn at 475 down the curve, I should probably at least take a little and hope that it's the worst sale that I make next year.
And what if so thought experiment, right? So what if the spread was a lot tighter, right, year over year? So let's say it was 4.25 as opposed to 475. Would you still be looking to lay some off then? Like,
I think that if you took me down to levels like that, now you're probably telling me that I'm definitively locking in a below break even cost. And
absolutely.
I probably would be standing pat. I probably wouldn't be looking to even be 10 to 15% aggressive at those type of values, just for the simple fact of I don't even have a real good handle on what my input situation looks next year. There are certainly times in business that you go lock a loss in and take it. I don't know that you ever do that 16 months early. And so
yeah, I don't think so. But I was curious. So then I guess would you then pick up the phone and call your partners and say, how locked in are we on our rotation for next year, and like what do beans look like? Like, or do you start to push them in those directions if you're seeing the market tell you that's what should happen?
Yeah, we'll stay fairly flexible up to the end. We're we are obviously, strip till, so that creates a little bit of a challenge of having flexibility in corn, but we did last year take a couple of fields that were on the fence and they were corn stalks, they were supposed to go to beans. We kind of lock ourselves in if we strip till corn stalks, so then you know that it's going to be corn. So all we did is went ahead and we chisel plowed them and we just kind of left them as flex acres. Those acres ended up being corn this year because we caught that rally in January, February. You had an opportunity to sell, just shy of $5 corn for new crop. And so that was one of those deals where the market took it and it bought those acres from us. And we were flexible enough to be able to take them. And then my rule on shifting acres always is if we shifted acres because I said that we should do it, I go sell that value so that I don't get told later, like,
Attaboy.
great job. You
Yeah.
lost us a lot of money. And so that is kind of the rule that we follow is if we are making that decision today to shift acres, we're going to go lock that up today because that decision likely is driving other people's decisions, which obviously it did. Um, and if you that is where you are making an educated business decision. Unlike, like you said, if corn were 425 for next year and we were 50 cents below break evens, I don't know that I could pull the trigger and make that decision today because that 16 months of time, there's a lot of things that'll change in between.
Yeah, the other thing that I like to remind people is if you're going to make that switch because you think corn's going to go higher, you don't have to make that switch. You can just go buy corn futures,
Yeah,
right? And go on with your merry way. I can't
100%.
imagine. So you talked about shifting deliveries on a Tuesday, right? Hey, we got to haul to Marquis instead of Ottawa or something.
Yep.
I can't imagine the call where it's like, hey, you know that 160 acres of beans that you bought seed for and are ready to plant? Yeah, that's going to corn.
Yeah, can you turn those back in? Like, is there like we're not doing that anymore.
Yeah.
So, in all honesty, we do tend to have things locked in by February type of deal.
Yeah.
After that, I try not to get too pushy on which direction things are going to go because by then you're you're kind of starting to fight against a lot of things. Fertilizer, seed, you know, is the ground prepared the way that it needs to be in order to go there? So um, we tend to, which over the next probably couple weeks, we still have some things that can flex back and forth. Um, we went heavy corn this year, and so naturally we're leaning heavier beans next year. If the USD balance sheet is right, that's a good bet. Um, if the USD balance sheet is wrong and everybody that's got a 700 carryout is right, that might not work out so well. So we're kind of trying to wait to see how things play out. Um, the fact of the matter is, November beans for next year,
Oh, 1075.
1076.
Yeah. 1070.
Um, I did an $11, 1102 accumulator earlier this week, and we're a little bit firmer. I mean, I need to run my numbers better, but with corn at 450 and beans at 1075, if we're going to be heavy beans next year, one can start to make the arguments that I should probably be taking a little bit more risk off in the bean market.
2.36 ratio there. So
Yeah.
I think like
So
that's like right on the line, right? It's very close to
yeah,
making
maybe a little. Yeah. I mean, it's
little pro beans, you think?
yeah, a little bit. So yeah, it it's kind of juggle the game a little bit here. We're aligned. If beans are the route that we're supposed to go next year, we're aligned for that. Um, we'll see. It seems despite the big supply news that is in the corn market today, the story that seems a little bit kind of lost in the weeds of, oh my God, this crop's at 188 is corn demand is freaking fantastic.
Yeah, that's right.
Um, it's it's fantastic. It's as good as it's ever been. Um, We're going to export 2.8, maybe 2.85 this year. They've got us plugged in for 2.875, I think, next year. Maybe that's high, but we're off to a frickin' fast start again. Ethanol margins are 20 to 35 cents a gallon. Fat cattle are record high. Broiler margins are record. Like everybody who touches corn is making money with corn. So
Yeah.
it is one of those things lost in the shuffle of once the supply news is digested, which if you look at the chart, you can start to make an argument that supply side news might be somewhat digested.
Yeah.
We've got a demand story. So I don't want to lose sight of that either. If we lose 3 or 4 bushel an acre over the next couple of reports from a USDA standpoint, yes, there's plenty of room in the balance sheet to pull demand expectations down just because you can probably assume flat price will be a little bit better. But I do think there's more optimism to corn than what people are kind of talking about today.
Yeah.
When demand is good, it it's a tough market to keep buried when everybody that can touch it can make money with it.
Yeah,
Such a
and on top of that, good carries, right? So you're rewarded for, I mean, you can get to those prices as you were talking about earlier.
Correct.
July feels a whole lot different than December, right?
Correct.
Yeah.
Well, I was
Correct.
going to ask Ronnie, what's the NPV on that? Like the when you bring the July back to D's and
Oh,
discount it.
man. I like it. It's so on corn, what I'm seeing for most guys, top of the carry is like May futures right now. So there's not enough carry to July to quite get there.
Yep.
For beans, it's I mean January for
Yeah.
sure. Like top of the carry is January just with
But like
price.
so what's the effective price for if May's the top on the corn, right? Like I'm just looking, it's like what 30 cents above the D. So but what does that come back to in terms of a December price equivalent?
Yep, I've got it here. So I'm looking at December at 405 versus July at say 426. Those are equivalents, right? Those aren't
Yep,
equivalent.
right.
Yeah.
Okay.
So I mean significant carry there still.
Yeah.
Yeah. We're looking at beans. It shifted out a little bit. So I've got um so February, right? Obviously nothing's trading in February, but 1052 equivalent off the March. And if I go out to June, which would be July, it's 1054.
Okay.
Gobbling it up.
So stir your corn, dump your beans.
I mean, that's what the market's kind of telling you. And honestly, we in our area, we had a chance to do really well on some fall basis numbers that on soybeans, right? Guys were looking for some soybeans to get snatched up. And at the time it took all the carry out of the market. Like it wasn't worth putting beans in the bin. Did you see any of that, Dean, in your area or
If you've got the benefit of either a crusher or in our area, the crusher equivalent tends to be the container market.
yeah, yeah.
The container program seems like late summer. It continues to run right through, and then it seems like they tend to have a really good book on, and then all of a sudden like October timeframe, it cools off a little bit before it catches foot again, like December forward. So it seems like they tend to fade a little bit once we get into the new crop, but it always seems like the container market is smoking on fumes and trying to find beans like July, August, September. And so you're not quite at new crop, but they do have values that they can kind of get you incentivized to try to go get some beans in September. And so that is more or less kind of what we saw this year is it felt like well, whether it was a container market, whether it's a crusher, whoever, September was still a month that they were willing to reach, and it wasn't like it was crazy premium, but it was a
No,
15 to 20 cent inverse to October that kind of gave you an opportunity to hit with some early beans and buy you some time to figure out what the rest of the world needs to look like.
that's exactly right. We were locking in option versus 30 under, right? Not
Correct.
like nothing crazy.
And
Yeah.
then figure life out.
Yeah. I think the most interesting part of this, Dean, that you said earlier is like on your own farm operation, it appears to me that the first thing you try to do is eliminate all futures risk.
Yes,
So then you can focus on the merchandising thing, which
correct.
is amazing because as a merchandiser, you don't have futures risk. So
Correct.
essentially futures risk is already eliminated, so you can focus on your merchandising. I think that's great, man. And I remember, when I was first starting this business and me and you were having some conversations around helping farmers with spreads, right? And a lot of the conversation we had was like, hey, if you have those sales on the books, then you can roll them out and make money and you can do all these things. And I was telling you like, yeah, dude, we don't have those sales on the books. Like we don't have that. And I remember like not that you couldn't manage it, we had to talk about it, but your mind was like bent a little bit like, I know we can manage this while we're long, but I just haven't thought about that, right?
Yeah.
I thought that was interesting.
Yeah. And it is kind of funny. So, I'm air quotes, I'm a trader, right? I'm a trader guy. And the first thing that everybody just kind of assumes from a trading perspective is like, oh, well, you're that guy that's in that crazy world where everything's I learned a long time ago. I have no edge in flat price futures. Like I can have a bias. I look at positioning. I look at when the funds are really short and the seasonals are turning and things look constructive, and I might take on some flat price risk in those type of things. Um, you know, trade war, Ukraine Russian war, uh, policy hits at 11 a.m. on a day randomly. Like all of these different items that drive flat price are are pretty much unpredictable to the majority of the world, right? I mean, the news hits and then you're in reactionary mode. So what I think a lot of people lose sight of is there are not a lot of outright true blue flat price traders in managed money. There is this versus that, long bean, short corn, long corn, short wheat, long the front end of the curve, short the back end of the curve, long Matif wheat versus Chicago wheat. Like it is a lot easier. Let me rephrase that. Nothing is easy. It is a lot more constructive way to trade relative value than it is the outright value of a specific commodity.
But
It is way
there's lower
easier to look at
volatility,
something.
right, in your day-to-day risk.
That's correct.
That's
I mean,
yeah.
it is way easier to look at one thing and then look at another thing and say that is cheap relative to this, or
Hmm.
this is expensive relative to that. And so I think the trap that a lot of people fall into is there's all these experts in the world that can predict price and predict a price of what a specific commodity is going to be. And there are folks out there that are fairly good at it, but I would say that there's a lot of those folks that also wear it a lot of the time. And so what I kind of learned, you know, obviously when I stepped off and I walked into more of the private equity side of things, you focus on what your edge is, what your strength is, where you see convergence, where you see that you understand relative value. I'm way better off living in that world. And I'm way better off watching futures and trying to say they've now gotten to a value where there's risk premium in them, there's profitability for me. I'm going to go ahead and keep taking some cake here and not try to get overly cute, try to put option structures in when I'm not comfortable obligating actual bushels to it and just manage it that way because, you know, staying flat price long all the time for eternity and hoping for a rally can be one of the more frustrating existence on this planet.
I think frustrating is a nice word for it.
Yeah.
Yeah, well, so I really like the term relative value, right?
Yeah, me too.
Talk about,
I'm gonna steal that from you, Dean.
Copyrighted. $5 every time you say it.
All right, I'll send it.
I mean, I've worked in a number of different roles over the years, and like what I talk about, like the most portable skill from being a trader, right, is relative value analysis.
Yep.
Because I think even if you are trading directionally, right, you're whatever, you're long a thing or short a thing, like you've still made a decision relative. You've at least said being long that position is on a relative basis. That's the best thing I know to be in right now.
Yep.
Right. I think when you talk about being in managed money, when you're managing other people's money, most people don't have the tolerance to handle the volatility and returns that you're talking about, right? And
Correct.
when you said people are good at it, like the people that are good at it like 53% of the time. Like they're not,
Correct.
right? And so yeah, there are a lot of losses, and they can be heavy. And so I think when you're trading similar things against each other, right, and capturing some sort of convergence or a dislocation in that internal relative value, I do think it's less effort because you've um, limited your scope of analysis, right? You've said like, so I don't need to compare. I don't need to look at all the. I'm not a commodity trader. I need to figure out what commodity to be long today because I'm a prop trader who goes long short stuff. It's I'm looking at relatively okay. I'm going to look at all the wheats. Let me look at the world of wheats and see how those relationships normally relate to each other.
Yep.
And so yeah, I and like you said, nothing's easy, but I do think it's easier, and it's less like generally speaking, your punishment for a bad trade is far less than a straight position.
Yeah.
Um, but yeah, I think it always comes down to the relative value, and it's just we I um, so a couple episodes ago we had Jake Maurer on. We were talking about benchmarking. I was thinking about this. I forget. I think I was reading like one of the old Dune books, and I forget what the line was, but it occurred to me like whether or not you believe in God or whatever, like if we just stick with like your standard Christianity thing, like the core premise there is like even God doesn't expect perfection, right?
Right.
And selling the high is perfection.
Yeah.
So so even the stories that we tell ourselves, like the most informed thing in the world, in the universe, doesn't do that. Like it
Correct.
doesn't expect that.
Correct.
And so when you open up that relative value analysis to the entire scope of all the things, like forget it, right? Like it just so yeah. So
It's,
I yeah.
yeah, it's not a realistic expectation to think you're going to be perfect in commodity marketing. Similarly to it's probably not realistic to think you're going to be Jesus. So it's,
Speak for yourself, Dean.
so the thing that I think a lot of people lose sight of from a commodity standpoint is just how so I'm a free market guy. Uh the market will fix things. Just stay out of its way. The problem with it is that is kind of an ugly existence. Like when the market needs to shut off supply or the market needs to ration demand, it it goes to somebody's financial pain point.
Yeah.
And that's what I think a lot of people lose in the sight of, especially from us from an ag perspective. Like we're in the ag business. We don't do this because we enjoy trading commodity markets. We don't we don't go out and, manage a family farm and, hop in our tractor and go just enjoy being out and about, working with people that we enjoy working with, you know, maintaining what you know, our relatives prior to us built and helped us still be able to do today. We don't do any of those things because we enjoy the pain that comes through the pain that a market can bring. And those are the things that I think, unfortunately, us in the ag world, we lose sight of that. Like the function of a market at times is to take people financially in distress and put them out. And when you put it into that sheer phrase of that's what the function of the market is at times, that is what should keep people trying to be proactive from a farmer marketing standpoint is there's no such thing as a guarantee. The government steps in and they try to save us from time to time. I don't want the government's help. In an ideal world, the government would stay out of our way. But unfortunately, the market still has a function. And when we produce too much of something, the function of the market is to shut that supply off. The only way to shut supply off is to make it uneconomical. And when you think about that from a corn and soybean grower perspective, when you're in Illinois and that's what you do, and the market is literally telling you that it's not going to reward you to do that, it's frustrating and it's a bad time.
Yeah.
But I think that's what we need to do a better job of at times is there always seems to be this expectation where, we as farmers say, well, I can't make money at that. I can't make money doing that, but I'm going to do it.
Yeah.
And then we kind of make that bet. Or I can't make as much money as I want to at that value. I can pay my bills, but I can't afford much beyond that next year at that price. There's no guarantees in this game. And the market will give you what it gives. And at times when we get into oversupplies, it will take everything. And that is kind of what keeps me being proactive is I've watched it not just from the ag side of things, but watching ethanol cycles go through, watching ethanol plants go bankrupt because margins get so terrible. Watching grain elevators go out because margin calls run them out of money. You know, all these different scenarios where you just watch a market absolutely pin somebody down and take them out. And if you keep that on the forefront of your mind with your marketing plan, I think it keeps you thinking more along the profitability standpoint than it does the speculative standpoint.
What I guess I do want to hit on something. I mean, it is this both with the market and the government for that matter. Like neither one actually cares about the individual.
Correct.
Right. And so you said, well, people don't want the government. Well, you may, even if you want the government, do you want to put yourself in a position where you have to rely on it?
Correct.
Right. Right. Like I think that's the bigger, and the same with the market. The market does not care about you. It doesn't care about anybody. And so,
No.
so it feels like at times, Rodney, you brought this up the other day, like you were like, is it really kind of trying to push the farmer? Like, no, it doesn't care about the farmer. It doesn't care about anybody.
No.
Yeah.
The market is does what it does, and to your point, the supply demand, that's what it cares about. It cares about.
It always has a function.
Yeah.
And sometimes that function is working for you, and sometimes it's working against you.
Well, but even that, I would say, yeah, and it's coincidence either way.
100%.
And
It's
yeah, so yeah, it is easy to think about it as a enemy, right? Or as a competitor, or like as an agent that has
Correct.
a will. And it's hard. Not only it's hard not to, because it does feel personal.
It does.
Right? I was in an equity position the other day, and I had a trailing stop on it and got stopped out. And it was the classic: I got stopped out, and it's just went right back up.
Of course.
Like, oh, they found my stop. No, nobody found my stop. My 100 shares of whatever. Like nobody cared about that.
Right.
Nobody sought that out. Like it's just. Otherwise, I'm an amazingly massive trader who has the ability to drive the market to new highs because I put in a 100 share stop. Like, and so yeah, I think we do a lot of work to try to talk about. Let's focus on profitability. Like, are you making a good decision for you?
Right.
Hope is not a plan, right? Like flat price risk, like you can do it, but it's insane. Like there's a reason with why managed money doesn't have flat price traders.
Correct.
I mean, and even like the big grain houses these days are far less profitable in that type of risk than they've ever been in the past.
Correct.
And they continue to move towards they want to play in markets that are opaque at best.
Yes.
So so the cash markets or whatever else it might be. Did you guys see is there a proposed merger between two of the east-west train lines?
Yes.
To go cross country?
Yes.
Yeah. So one or two people maybe are talking about that. Maybe.
Yeah. It's
what's the vibe? What's that?
BNNS.
Yeah. Man, just that's like essentially everything in the grain world, right?
Well, which once you put the BNNS together, just naturally the next thing is, I wonder when the UP and CSX are going to meet up. Like it just,
yeah.
I mean, and naturally, so then we're going to be down to two railroads that are going to tell us, what freight cost on the railroad.
Well, yeah. I almost fell out of my chair when I read the article. I don't know who it was, probably in the Journal or something, but it was like, oh, this will be way more efficient, cheaper freight prices.
Yeah,
it's like
it'll go down for sure.
Yeah. Oh, definitely get cheaper for everybody. I was talking about I talked about paid search the other day. I think I brought this up, right? Like, so I am now paying to not use Google.
That's right. Yeah.
So I actually put my credit card through the other day. I used up the free cert. I love it. It's amazing. It's so much better. So
Okay.
much better.
Okay.
Uh, it's like I think it's like $10 a month, and I don't see any ads. And if I don't want to see certain websites, like I can remove them from the search results by default. I can deprioritize so it doesn't actually remove them, but like lowers it. It My search is so much more efficient. I feel like I found the internet again. Like you know how I don't know about you guys, but like before that, right? I was searching and it was like everything was either Reddit or Amazon or like Pinterest. Right?
Yeah.
It's like one of those three. And now it's like I see the whole internet again, and it's awesome. And some of it's terrible, but it's okay, right? Like I am capable of navigating what I'm looking
Right.
for.
Yeah.
Uh,
I can sift through the good and the bad. Just give me it all. Yeah.
yeah, right. Like and but I'm bringing that up because I was talking to somebody else about it, and there was an article written like 10 years ago about like the enshittification of things. And so the idea being the way kind of new things work, especially under capitalism. So think about Amazon. So when Amazon first came out, it was amazing. So basically, they raised all this money, and they were basically using that money to subsidize like shipping and the cost of things. And so, like as a consumer, it was like, "Ooh, I can get this faster, cheaper than all the competitors." Right? Drives out a business, all the local, right, brick and mortar stuff. And then fast forward to today, like it is far less satisfying, right? Like prices are going up and up and up. Like yeah. So they've trained people not to go look at competing stuff. Like it's a whole different, and same with Google, right? Like so now more ads than ever are showing up the page. A buddy of mine said that some internal memo was released where basically they knew search results are getting worse, but they actually like that because you spend more time looking at the ads,
Mm.
stuff like that. Like which I get it. Like as a business, like I get
Yeah.
it. So now here I am paying like, and that's just how it goes, right? It's like it is very much the classic you get what you pay for. So sorry, but when I saw the railroad, I was totally thinking about like for about 5 minutes there will be better pricing, and
Yeah.
then like every day after that will get worse and worse and worse.
Yeah. I mean,
Yeah.
it's two people deciding price points. It's like, you know, put Rodney Connor and myself in charge of Bush Light prices for a day. And let me tell you if they look fair at the end of the day.
That's right. So, Dean, I just look back. So, December corn has traded a 90-cent range since like February 18th, whatever we put in that high.
Yep.
And farmers are flat price traders, right? They're long forever. So, ultimately getting short just really gets them flat. And when me and you are talking about like merchandising type stuff, right? We're worried about spreads moving, you know, 3 cents, 4 cents, 5 cents. Sure, there's like more than that. So, like, how much stock should a farmer put into the merchandising side, given the fact that they have this flat price risk?
Um, so I think the first way to kind of answer that is the first thing you have to do in order to be able to look at it as adding value from a merchandising standpoint is I think you have to have it hedged right first. Um, it's not always going to be the case. It doesn't mean that you stop merchandising if you have it unpriced, because obviously you're still looking for the top of the carry. You're still looking for all of these different things. But obviously, having a, a flat price position established gives you certainly a big advantage from a merchandising perspective, because kind of what we had talked about earlier. Once I kind of have that established, now I can actually start looking at merchandising as strictly economics. And I think what gets lost to the farmer a lot of times with us on the commercial standpoint is they struggle at times to recognize how is the commercial capitalizing on the cash basis. Are they my corn rallied a dollar, so the elevator made the dollar. I didn't get the dollar. Well, that's not accurate. The commercial elevator is going to be as close to home on flat price as possible. They're managing it through basis and spreads. And so I think when a lot of times when a farmer thinks about his bin, he thinks about first, that's the place that he gets to dump in the fall, and it's easier than going to the elevator because I can dump there whenever I want and I can run as late as I want and I can do it's mine. I own the logistics on it.
Yeah.
All of that is true, and it's 100% accurate. I think what they lose the sight of is once it's in the bin, now it's just an extension of their long position that they had all summer long anyways. And so now, yes, you have picked up logistics, but you haven't changed your marketing plan. Your marketing plan is still that you're just long flat price.
Yeah.
And so it doesn't take away the fact that if I fill the bin, I can probably look at the summer and I can see 40 to 50 cents carry. I can go sell that as soon as I fill the bin. I can capture that carry. Um, the beauty of having a flat price established is now I can be flexible. If basis doesn't converge well against the December contract for corn, the spread should pay me more carry. Now I get to roll to March and it should cover my cost plus. I get to pick up X amount of cents. The beauty of the spreads are they build a commercial storage rate into the spreads. So as long as basis is not converging, you've got 8 cents a month of storage that tends to build into the spread. If things are really bearish, they'll even stretch out into interest cost. So you can stretch a spread to, the DSMarch at full storage values is 24 cents now. And so you think about if I have corn hedged at 450 and we get to the fall and corn is 380, and if I've got 20 more cents to go to March, as I roll out, theoretically, I just turned my 450 corn sale into a 470 corn sale.
That's right.
Well, granted, I have to take my cost of carrying it to that position into effect. I've probably got 2 or 3 cents a month of interest cost, and I've got some shrink risk and all of these different things that can happen. But theoretically, I pick up that extra 20 cents. If basis doesn't come to me in March, then I can theoretically I can keep rolling out. Or the market will tell me what to do. As soon as it stops paying me carry to have that bushel of corn in the bin, I'm no longer getting paid to maintain that position. I should sell my corn. And so it puts it kind of puts the keys in your hand. Once you establish that price, now basis will tell me what to do with that inventory. I've taken the flat price management out of it. Now I just need to wait for basis values to tell me when the market is asking me not to be carrying that inventory, and I liquidate the position. I turn it into cash. I move on. And that I think is a component that gets missed a lot is corn at 35 under in the fall to the elevator that turns into 5 over the March or 5 over the May or whatever numbers you want to use. There is 50 or 60 cents of value that is in that transaction string if you execute that transaction string. If you fill the bin up and forget about it and don't lock any of that in any way, shape, or form, and flat price doesn't perform, you can miss out on that 50 cent of transaction string by doing nothing.
And it's not fair to say that 50 cents is risk free, but because of what we talked about before, it's significantly lower risk than just
Correct.
that straight long.
Well, and it's probably a risk you know how to manage, right? You have
Right.
you have some agency over it as opposed to the market doing things to you.
Correct.
Yeah,
Correct.
That makes it, I think, fundamentally different, right? Like, I mean, again, like going back to when we used to trade options, right? It was like we're going to shape this portfolio to have the risk on that we want, right? It wasn't about eliminating all the risk. It was taking on what we thought was the risk that we wanted at a given point in time.
Yep.
And so that I'll reframe it. Like the question people should be asking themselves is this the risk that I want on?
Correct.
And so okay, if you want the flat prices, great. Like here's what that looks like. It's 90 cents since Feb, like, just to calibrate it, like that's what could happen. So,
well, if you've got 100,000 bushel bin filled with, $4 corn, it doesn't cost you $400,000 to take a long position on the CME. So like, if that's why you own a bin, it's still a hard justification because in a few clicks of a button, Rodney can get you a position on the CME, and it'll be far less money than
you don't even need to be a farmer then.
You don't have to be a farmer, and I'll charge you way less than 400.
So, that is part of the mentality that I think we have to try to keep getting people to adopt to is corn in the bin is cash. And it's not free to lug it. As long as you are paying somebody on a note, paying an operating line, paying whatever, even if you're not paying on a line, that corn is worth 4.5% on a 30-day T-bill today. So like
Yeah.
there's an opportunity cost in not having that be cash unless you're getting paid to overcome that cost in the carry structure.
Yeah.
And so the the thing that I think we need to continue to get better at from the farming side of things is commercial storage that gets built doesn't get built based off of flat price. Commercial space gets built because of returns to cash carries. And as farmers, we need to start doing a better job of getting our return to space based off of the cash values and stop using them as an excuse for our flat price perspective because there are 1,000 different avenues to get long flat price, and it doesn't have to be a bin full of corn. It's the most expensive way to be long flat price that there is out there of all the options that you have.
Yeah, that's right. Man, so I've known Dean for 12 years. Dean's been teaching me about the grain business since he pulled into the gravel parking lot in Mazan in his silver Hyundai. Well, did you have a Hyundai? What was that thing?
Uh,
Hatchback. I don't know. Doesn't matter.
oh, I had a Highlander. I had a Toyota.
Highlander. Yeah,
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 yeah.
yeah. But the thing that landed most with me that Dean said, and I'm glad it came up today, is this: listen to what the market is telling you, right? The market is trying to tell you what to do. And I think once you wrap your head around that statement, which is hard and complicated, and there's a lot to it, and I still have a lot to learn around it. I think it just simplifies everything, right? Even if it is changing your position around every single day, right? It's simpler to manage because you're just reacting to what the market's telling you, right?
Well, and I think too, getting back to, you know, buying acres and all these things, we go into the winter and you hear, well, the corn market's trying to buy acres and the bean market's trying to buy acres. And I still feel like there's this mentality out there in the ag community that like, well, corn's $5 in February, it'll be worth $7 in July. Like
Yeah.
that's just how it's going to happen. And I think sticking with that, what is the market trying to tell us thing when you're standing there in July or in January or February and you see really, really strong returns for corn for next year. The market is telling you at that point in time, plant corn, sell corn.
Yeah.
The only reason we get rallies in the summer is when we get weather risk. Weather risk works both ways. Weather can be good, weather can be bad.
Clearly. Yeah.
But once that once that market feels like it's secured the corn acres that it has, by the time we get to March and we get that report and we find out that we have the corn acres, the market no longer has the function of trying to buy more corn acres. In fact, now it's plugging in the corn acres that it bought and finding out whether it actually needed that many or whether it maybe needs to rally and buy a few more. But it's always evolving and it's trading further down the line.
Yeah.
And what we don't do a good enough job of is saying, yes, the market is asking me to plant corn. So I'm going to plant corn. The piece missing in that whole string is, oh yeah, and I need to go sell corn. Like if I'm making a business decision, I should be locking that decision up. And obviously you can be flexible in a million different ways. You can go sell corn and buy calls, you can do all these different things. But the number one thing to do is if you're making a business decision today based off of the price that you see out there, you should be doing everything you can to manage the price that you're doing it for.
Yeah. That's right.
Rodney, should we bring up live cattle real quick?
Yeah, let's do it. We always close with live cattle here, Dean.
All right, cattle.
Yeah.
Well,
What do we do?
so I'm let's see. So first of all, new highs this week.
Is
Yep.
this new high today?
Not today, I don't think.
No, I think they were off a little bit today.
Okay.
Yeah. But so Dean, back in somewhere in here, we started talking about it and how is it record highs already, and so where I said so we're entering in our first or September. I said this fall things are I'm worried from a macro perspective things are going to turn and so and there was a couple times where it looked like it might have been turning right like here.
Yep.
But yeah, but here it is, screaming high. Now, I was talking to an old boss of mine earlier this week, and I was talking to him about the cattle stuff and like what positions I'm in, and I specifically said, "Here's my macro view: is I'm worried about the whole macro situation, right? Unemployment hitting this fall hard, and expect high cost protein consumption dropping like a rock, and then it having like this large knockdown effect." I said, but to be clear, I have no position on there. Like I have not put on a position to take advantage of that view yet. I don't know if I will or not. Like there's a lot of volatility wrapped up on it. And the other thing is I hope that I'm wrong. Like I don't want a recession, right? I don't
Right.
want a big macro hit.
Yep.
But that's in but I'll say the thing that kind of sealed it for me was we had Nate Brobitz, who's he was at ADM in Cargill, and he runs a calf cattle operation and has his own acres and all that kind of stuff. And he was talking about how it feels like in the cattle space a lot like it did in '07 with grain, with row crop stuff, in terms of the cattle guys are actually really stressed. They're not excited about these levels. Like it's super stressful for them.
Yep.
Um, and so that makes it feel all the more irrational from a fundamental perspective, which makes it feel like there is a bottom here that will fall out. But I'm using the word feel a lot, which is not, the most reliable thing. Anyway, so far, continue to be wrong. I continue to be wrong about this market dropping hard, but yeah.
That's because consumer demand won't go away. Dean and I were actually just talking about this morning. I think he had steak for dinner on Sunday night as opposed to chicken or something.
Yeah,
Well,
I'm part of the problem, honestly.
well, we had somebody on Catherine Gawinski 2 weeks ago who was like, yeah, we had this big barbecue and we paid 4 times what we normally pay for this big old brisket. I was like, and you were gonna, and if it was 5 times, you'd have paid two. Yeah, yeah, like,
Paid
Yeah.
it. Yeah.
yeah. So, yeah, well, as long as people have jobs, I think people keep eating beef. But
Yeah.
so like
Yeah.
I said, I hope I'm wrong, and I hope.
So I had to learn a lesson on, you know, some of beef demand is obviously not inelastic, but it is the harder demand component to break. And Morgan Paisley, a guy that I learned a lot about, through the meat markets and things and conversation through the years. He was always big on, you look at the spread between pork and beef and chicken and all these different things. You go to the counter, and I told Rodney this story this morning. My kids were gone Sunday evening. I told my wife I'm gonna go get something to grill. You know, I'll be back, type of thing. So I go to the store. Uh, Chicken breasts are 350 a piece sitting on one side of the counter. Pork chops are like 350 or $4 a piece. Beef tenderloins are 35.99 a pound. I came home with two beef tenderloin steaks. So literally the economical thing is screaming in your face standing in the glass case. But it was one of those deals where it's like, well, if I'm gonna go grill, and if I told my wife like, hey, the kids are gone and I'm gonna grill something, if I came home with two chicken breasts, like I might as well have been driving a Yugo home too. Like
Sure.
so like I think the demand base from a beef perspective, and that's part of what keeps driving the cattle market. Everybody has been predicting the box beef values to top out, and it seasonally always does about this time of year. You get just past peak grilling demand, you get past holiday booking demand, and beef tends to relax until you get back into the cooler weather fall, and then all of a sudden maybe you pick up some more demand. But like I think there's a bigger underlying thing behind that where stock markets at all-time highs. House values are at all-time highs. People's 401ks are at all-time highs. The inflation that took place and regardless of stats is still taking place. Um, the middle class, the mid-middle class and down is feeling the brunt of what that inflation does, right? If you're at some level and up, you're probably benefiting from it. If you're at some level and down, you're probably not benefiting from it. And so from here up, beef demand is almost inelastic. Like those people don't tend to go buy ground pork and say that's what we're having for supper. Those people don't go buy chicken breast and throw them on the grill type of thing on a consistent basis. Your people that are actually getting hurt through what we're going through at this current time are the people that tend to consume more pork, more cheaper pork cuts, more chicken cuts, more of those type of things. And they're the demand that is actually hurting. So you're looking at pork being extremely cheap, and pork can't seem to find demand. You're looking at chicken, pretty cheap. Chicken demand is really, really good, but it's not, it's because it's priced at a value relative. And in the meantime, beef is untouchable for a big percentage of the people that are out there, but the people that can just continue to buy the higher end cuts. And when you can sell higher end cuts, the box beef cutout just stays at crazy high levels because that's what they have to justify for what they're paying for fat cattle.
So then what do you think about, or we're going on a whole different angle here, but like, so, there's, I think, a lot of data on the redistribution of those populations, right? So fair enough. Like, let's agree that there's that middle like point, and that's the cutoff. But I think if that's a dollar amount, right? The population below that dollar amount, that income level, is much larger than the population above that income level. And what we're seeing right now in terms of layoffs, it is somewhere around there. Like we're going through a large white collar, which tend to be what those income levels are.
Yep.
Recession, right? And from like the unemployment's hitting that level, that area hardest, right? We can say AI or whatever, but that right now, that is where those layoffs are hitting.
Yep.
And so those incomes then get reallocated, right, to that lower tier. So that's for what it's worth, that's where I'm coming from. I think we're going to see like that population below the line continue to expand and the one above shrink. I totally agree that above some income level, like demand is inelastic. Like they're not people. Like you said, you were going to store to get something to grill. You were not looking. You weren't like, I need protein to feed the family. You were like,
right.
Hey, it's a.
I'm trying to impress my wife. My kids are gone.
Yeah, totally different situation. And so yeah, like it's yeah, but like yeah, and I guess I'm probably anchored because I do talk to my buddy in Nebraska like with some frequency. I'd say frequency, quarterly. Like we do talk about those prices, like around hamburger and stuff like that. And I don't buy the food for my house, right? So my wife does. So what happens is when I get off the phone with him and he tells me prices are 3 times higher, then I turn around and ask her, like, what are we doing?
Right. Right.
Like, I don't know. I bought 5 dozen eggs. Like, okay, great.
Yeah.
Right. And in fact, we had that big call. I literally came downstairs right after, and she was like, I don't remember what it was, but it was like she had just made, I don't know, like 20 steaks or something. Like it was something like, I was like, I don't think we eat that much beef. I come downstairs, like, it's like somebody slaughtered half a cow, like, and just cooked it up. So I don't know what's going on, right? Yeah. I show up and I'm just thrilled. I didn't have to make anything, and I'm grateful for whatever it is I eat. But yeah.
Well, the funny part is, you're kind of trying to figure out like, okay, well, what's the function of the market? And when you think about it from a cattle perspective, like the cattle numbers just aren't there. And the cattle cycle is not something that you can flip a switch and make cattle show up tomorrow. So like the function of the market is to drive beef prices to the pain point. And what I think is surprising everybody is here we are at these sky high levels, and the packer keeps getting to pass along those values. And therefore, he's able to go out and pay $240 cash for fat cattle, grind them through the machine, and still sell box beef values. Like the top in the cattle market doesn't feel like it's going to come from the supply side. It's got to come from the demand. You have to get the box beef to crater. Then the packer can't pass along that through to the fat cattle guy. So then he's got to drive cash values lower and slow chain speed and back cattle up and do all of those things in order to get things back into line. But like the main driver right now, it still doesn't feel like we're at herd retention. Like the guys that I talk to that are, you know, cattle operators, it's like, do I want to hold a heifer back that is worth what she's worth today? Like in this market, it's
Yeah.
crazy. I don't even want to raise cow calf pairs because the heifer's worth so much more money going through the meat grinder. So it's we're not at the herd rebuild point. So if you're not at the herd rebuild point and prices are where they're at, the only next thing that you can do is put beef at a value that makes Rodney Connor stop eating New York strip every night.
That, by the way, we've gotten to that price. We did my parents for Christmas have always gotten us a quarter beef. I don't know if I told you that, Gabe, but those prices have crept up over the past few years, and I've told my dad for years now, like, hey man, you don't have to do this anymore. We'll help pay for it, like whatever. So I literally just sat down with him, I think Saturday night, and was like, no more, no more. I call it the Christmas cow. I'm like, no more Christmas cow because it's just too expensive.
You know what would probably guarantee that he won't do it is if you
You
just say,
said no
you know what,
Christmas.
instead of buying the quarter cow, I'll just take the cash.
Yeah. Oh,
I remember, we used to go when any article would hit or whatever, any headline would hit about some company that was doing real well. Like that was the death knell, right? Like you knew it was overbought or whatever. So I'm curious, like when we see the New York Times article about like, hey, you need to get into cattle,
Yeah, yeah.
like that, maybe that's what we should just keep an eye out for. But I like that's but I mean, look, I'm a staunch capitalist, but markets get overly excited, right? Like there are, I would love the market to always be rational. It is not.
but it's hard to call tops and bottoms. Dean, remember Ottawa put in their second microbrewery in like 2015, and we called the top in on microbreweries in 2015. We were way off,
We'd
way
be out of
off.
money by now.
Yeah.
We've hit it though, right?
Well, only because young people don't drink anymore.
Well,
Yeah.
so yeah, well, but I did see. I literally saw a headline like was it like Nielsen or whatever like measures that shit,
Yeah,
like alcohol consumption all time low.
for sure. Yeah. Yeah, I
But in
missed
the
it by 10
meantime,
years.
but in the meantime, every town that has more than 1,000 people has 3 breweries.
Yeah, right.
We've started. So I mean, Boston drinks a lot, like like just as a whole. And we've started it like every couple of weeks. Like I feel like there's a new headline about whatever microbrewery is shutting down or is
Yeah.
merged or whoever. So I mean, here I would say I think it's topped out.
Yeah.
But
Being 10 years early isn't too bad, Rodney.
I'm out of
We were,
margin for
we were
sure.
close.
a
Yeah.
lot of people lost a lot of money being right.
Yeah, exactly. That's right.
It's sometimes a really expensive venture to be right.
Yeah.
All right.
Dean, man, thanks for your time this afternoon. I know I always walk away a little smarter after talking to you. Anything you want to plug on your way out? You starting up a podcast or a band or anything like that?
Pearl
No,
Jam cover band.
I mean the Pearl Jam cover band thing has been a dream for a long time, but I don't know, feel like that dream is probably dying.
Yeah.
No, I mean I don't know that I have anything major to plug other than, you know, um, hey, things always look pretty rough on the bottom side of things. I think there's some things here that there is some optimism, but I think it's going to take us a little time to chew through some of the problems that we have here on the front end. But I don't want to lose sight of the demand story. Once we get the supply story kind of tucked away and are no longer talking about how big the crop is and how it's getting bigger every day, and well, we saw this report, wait until this next report is going to be bigger yet, and we kind of can put some of that supply side stuff away. I do think there's some constructive things that are out there. You just you got to stay nimble, and in the meantime, I think the best decisions that you can make is just looking at it from a merchandising perspective. There's big cash carries that are in the market, and if there's any way that you can capture those things and, you know, capture another 40 cents, 50 cents, 60 cents type of thing in this environment, it's a big deal. And
Yeah.
anything you can do to be creative to try to figure out how to get yourself climbed up the ladder on the carry is value.
Yeah. Cool.
So Dean's plug in, build some bins and find more uses for beans and corn.
Build
That's
some
what I heard.
bins, empty out the machine shed, sweep the concrete floor and put a tarp down. Anything.
for sure.
Big carries create creativity.
Yeah, that's right. Cool. Well, good talking to you, Dean. Gabe,
All right,
always
guys.
good
Good
to
to
see
meet
you
you.
too. Have a good one,
Ryan.
guys. Thank you.
Sounds good. We'll see you.